Neeraj, as far as cement is concerned, my sense is the larger players, like Ultratech, Ambuja Cements, in South, Ramco, India Cement, they should benefit because a greater degree of pricing power is now getting visible. And I think October to March is a period when, the industry ramps up the production, the price increases also happen because post monsoons construction activity takes off. My sense is that Ambuja Cement still looks pretty good. On the south market side, I would believe that Ramco Cements and even India Cements, which commands a very large capacity, can be considered. But I think clearly, on a very stable note, I think Ultratech definitely enjoys a pan-India coverage. So I think Ultratech is some company which I would believe that at any dip, one should definitely look at accumulating the stock. But I think Ambuja deserves a second look, and I think we have been telling our clients to buy into Ambuja Cement because we believe that the kind of cost reduction and the kind of raw material cost savings which the company would now benefit from because we have been hearing that pet coke prices have come down. So all this would definitely lead to a better kind of earnings growth and a better kind of profit expansion, at least over the next say 2 to 3 quarters. So we are positive on the space, but we are in no hurry. I think Ambuja Cements and Ultratech are our topics. We would believe that it's always better to buy on any normal market correction. This kind of market, I think you have to be very careful about valuations. And I think clearly, despite the fact that secular growth would continue, we would be buyers on dips, not in the current market. I think clearly, one factor is obviously the currency factor, and secondly, domestic demand, specifically infrastructure demand, Neeraj, is growing very rapidly. So I think most of the steel and metal companies are going to benefit from significant, ramp up in the domestic demand. And prices have also remained more or less, at steady levels. Although the global market for metals is not very aggressively, going up. People are awaiting that when China could re-enter the metal market, so that there could be a big surge in both volume as well as price. But I think clearly, if you look at companies like NMDC, Tata Steel, Hindalco, we are seeing a lot of demand coming in from core sectors, and demand continues to be rock solid. So maybe, compared to the second quarter, the third quarter for these companies could definitely be good. And one interesting part about almost all the metal companies is that these companies have managed to reduce leverage significantly on their books during the upturn. So I think whether it is Tata Steel, whether it is SAIL, whether it is companies like even NMDC, these companies have made a conscious effort to reduce debt. So the margin of safety is definitely much better now compared to about a couple of years back when the balance sheets were very heavily leveraged. So I think that is also one factor which is driving the market. When mostly steel prices are more or less bottomed out, and I think any rise, if the steel prices are high, that could lead to a significant re-rating. So I think we have been talking to a lot of market people from the steel market, and they have been telling us that steel prices are more or less bottomed out, and any price increase could actually result in a big re-rating in these counters. So I think that's probably the key reason why there's a lot of interest in these companies. The risk to lose capital is minimal, but the upside could come in quite significantly. As far as the IPO market is concerned, I think Happy Forgings opened at a decent premium. See, it's one of those large forging players with a large percentage of machined components. And I think the markets would obviously give it, a further re-rating and a further thumbs up once the quarterly numbers are out. But I think the commentary from the management during the IPO time was pretty solid. They have a large order book, a very marquee customer base. So I think Happy Forgings and Credo bags, brands, which actually does a lot of work for the Mufti brand. I think it initially opened weak, but I think definitely it's got a decent kind of retail exposure. Has been quite profitable. So I think even at these levels, one could considering the fact that it opened pretty weak today. In the second half of the trading session, it picked up. As far as RBZ Jewelers is concerned, I think it's a very small player in the jewelry space. Would prefer to wait for some more time because the IPO price was about 100 odd rupees, and the stock is trading at just about 105 odd. So I would believe that Happy Forgings would be a good buy, maybe some on some market declines. And Credo could possibly be bought even at the current levels. Our sense is that within the retail space, Credo could definitely scale up operations quite significantly. So these two could be a decent kind of bet. But again, from a medium to long term perspective, I think IPO valuations and IPO prices have to be considered from the fact that a lot of short term money gets into these kind of IPOs, and there are some exits. So I mean, keep a time frame of at least 12-15 months to get a decent risk reward. I think clearly I would play it on geography, and we are positive on real estate companies which operates in markets like Mumbai, or for that reason Gurgaon in North India. Our sense is that in tier 2, tier 3 markets also there are very good opportunities. So typically, in the larger cap space, we continue to like DLF from North India. DLF continues to do very well. Our sense is that we could see very strong numbers in this third quarter number. And another smaller company, Anantraj, which also is into the Gurgaon market, has a very good, a land bank. At the same time, also has entered the data center business. So I think clearly, these two companies from North India and from the Bombay market, I think we are very positive on Oberoi Realty. We believe that in the Mumbai market, prices have actually remained pretty firm, and inventories have been moving pretty smoothly. So I think it's going to be on geography. I would not purely go on the mix, because most of these companies have got a middle to upper end kind of customer kind of segment. And clearly, luxury has taken a significant kind of share in the overall mix of these players. So I think that is going to get reflected into better numbers. I think the markets have obviously realized that it's a mix of more of luxury and less of affordable is something which is going to help the real estate builders. I mean, the luxury market, especially the villa market, the bungalow market in North India, has been recording very strong growth and with good price improvements, and plus very good fast inventory kind of sales. So I think probably these two, one or two companies could be better. Oberoi Realty is a more of a stable player from the Mumbai market. We are very clear that unless inventory crosses a particular level and there is some supply kind of pressure, the market for real estate would continue to do very well, at least for the next 3 to 4 quarters. I think Oil India and ONGC are pure plays. If crude prices continue to rise further, because clearly my sense is that if crude prices don't get further elevated, then I think profitability for ONGC is directly related to the crude prices. My sense is even Oil India, according to me, would get re-rated only if we get crude prices of say $95 or $98 a barrel. I think the bigger beneficiary still now continues to be the oil marketing companies. Although to a large extent these companies have jumped significantly, I would still believe that once the third quarter numbers come in, fourth quarter numbers come in, you could see the improvement in GRMs for these companies. So I think upstream companies will have to wait for some more time to show decent numbers. Although ONGC definitely looks attractive, but I think the movement in the stock would be a pretty slow process. Markets would obviously give a better thumbs up and a better re-rating to the oil marketing company. I think I would not be able to give you a 2-day or a 1-day call, but I think in the capital goods space, we are positive on Cummins. We believe the stock has been consolidating, and I think you could see very strong numbers in quarter three. We are, not very far away from the quarter three earnings season. So my guess is that Cummins at around 1980-85 could be a good entry point. We have a fair value around 22-22.50. So I think the best part is they're all ready with products from the hydrogen space, and a lot of activity has been happening there. Our sense is that post elections you could see a lot of noise on the hydrogen opportunity, and that is when Cummins could get significantly re-rated. But in most of the core earnings areas, I think they enjoy a large order book, a very good export kind of market. So I think 1980-1985 could be a good entry point, provided somebody has got a 6 to 12 months kind of time frame. See, I think Zen is one of those companies which has got virtually no debt on the books, a 1,400 crore order book. And I think in the drone market, it's one of those well-established players. So the revenue visibility for the next 2 to 2.5 years is very solid. I would not be surprised that possibly you could see some sort of significant upside here. Maybe a fair value around 950, 960, because I think the markets are extremely happy that visibility is extremely strong. And these are one of the few early bird which have got a significant order from the defense, segment. And drones is one area where I think they have a decent market share. So I think around 950, 960 could be a fair value. Even at the current levels, an investor who wants to, chip in and wait for the next 6 to 12 months would expect a decent risk reward. They look pretty solid. I think one would be, the broader auto component market. And secondly, a little underrated sector, Neeraj, would be the agrochemical market. I think within the auto component markets, we are very positive on companies like Bharat Forge and Sundram Fasteners. We believe that earnings growth for the next financial year, that is FY25, could be at least 20 to 22%. So I think clearly Bharat Forge has a very large order book, has a presence not only in the US American market, but even the domestic commercial vehicle market. They have a large defense kind of business. So I think Bharat Forge should definitely gain momentum. And as far as Sundram Fasteners is concerned, it's a quality play in the engine component space. A very well managed company. My sense is that probably in the next 1 year, the US market for them would open up significantly. And domestically, they are very well present across all the segments. That is, the four-wheeler segments, including tractors, commercial vehicles, as well as the utility vehicle pack. And from the agrochemical space, I think UPL, which announced a rights issue, I think prices have come down from a pretty significantly higher levels. At these levels, I think, one could definitely take a punt here, considering that the next financial year for agrochemicals could be significantly better. The first year for, the season for this year has got completely spoiled. But I believe the next season could definitely be very well poised, especially for the domestic market. And I think we could see levels of 675, 700 here. So I think at 582, there's very little to lose. And I think it could be a good contra bet in the current scenario.